Morning. Hands up who found £50 billion down the back of their sofa this week? No? Don't know where all this money's coming from. When the Chancellor was going through his we get it done routine, I just couldn't get Bob the Builder out of my mind. Can we fix it? Yes, we can. That's my image of the Chancellor. I'm going to give you a brief overview of some of the minor points in the budget, then cover pensions and some changes to residential properties. Note the personal allowances are unchanged, still 12,500. The basic rate band is unchanged, but they have met their promise of extending the point at which people start to pay higher rate tax to £50,000. The dividend allowance, where your first £2,000 of dividends are taxed at 0%, that's unchanged. The personal savings allowance, so £1,000 of interest received by a basic rate taxpayer is tax-free, and £500 for a higher rate taxpayer, no changes. Very surprising, no inheritance tax changes. Despite numerous consultations by HMRC, there are no changes, although we do expect that there might be something in the autumn budget. There's no further news about making tax digital for income tax, although we are now in the throes of making tax digital for VAT, and our online services people are here if you want to chat to them about that. And then one final point, and I think we have some insolvency practitioners in the room. New rules from December 2020, where an insolvent business is insolvent. HMRC will be a secondary preferential creditor for VAT, pay-as-you-earn, income tax deducted under pay-as-you-earn, employees' NIC and student loan deductions. But this doesn't cover corporation tax or employers' NIC. Vans and cars, I think this is worth mentioning because the car benefit regime and the way in which capital allowances are given for vehicles depends very much now on the energy efficiency and their emissions. Currently, 100% first-year capital allowances are available for low-emission cars, zero-emission goods vehicles and equipment for gas refuelling stations. And this was going to come to an end in April 21. It's actually been extended now, this beneficial capital allowances rate, to April 2025, but cars will only be eligible after 2021 if they have 0% emissions, so in other words, electric vehicles. And it's all part of a push to get us all into electric vehicles. And from April 21, capital allowances for higher emission vehicles of up to 50 grams per kilometre will be 18%, and only 6% for vehicles over that. So there's obviously a clear incentive to go for a lower emission vehicle. Car and van benefits, quite a few of you will already be aware that if you provide a company van and there's private use for the van, the benefit in kind is much lower than a company car. So that's going up to $3,490, and the fuel benefit is $666. From April 2021, the private use of zero-emission vans will attract no tax charge. So I envisage lots of directors driving around in milk floats. Actually, on the subject of milk floats, one of my colleagues knows all the words to the song, Ernie, he drove the fastest milk cart in the West, if you remember Benny Hill's song. Car benefits will be increased by CPI, and car fuel benefit is going up to 24,550 times the multiplier for your car benefit. Pensions. I think there was all the usual scaremongering about pension relief, higher rate tax relief would go, perhaps employers' NIC would be charged on salary sacrifice arrangements for pension contributions. But fortunately, for most people, the rules about tax relief for pension contributions is as you were. So no changes to national insurance salary sacrifice. The lifetime savings limit is increased to 1,073,000. And personal pension contributions are still very useful for people who are caught in the bracket between 100,000 and 125, where they lose their personal allowance. I've just done an example to show you the effect of paying a contribution. So if you have income of 125,000, currently you would receive no personal allowance, and you'd pay tax of £42,500. If you made a net pension contribution of £20,000, your tax liability reduces to £32,500, and that's because you're getting your personal allowance back at 40%, so that's £5,000 of tax relief, and you're getting higher rate tax relief on the pension contribution itself, which is another £5,000 of relief. So to put £25,000 into your pension fund in these circumstances, the net cost is only £10,000. Now that is really good value. Just what the doctor ordered. Now you may have heard there's been a lot of problems for consultants in the NHS who have simply stopped working overtime because they don't want to increase their income because that increases the pension charge. And the last thing we need at the moment is people in the NHS not working to full capacity. So after a lot of pressure, these rules have been changed. Basically, the issue is that if your income, your taxable income is over £110,000 and your employer makes a substantial pension contribution into your pension fund, now with the NHS, doctors' pension contributions are measured by the growth in the pension fund each year. So if your pension fund's gone up a lot, the value of that pension contribution is substantial. So if you had taxable income of 110 and adjusted income, which is the income plus the employer pension contribution of 150, you would suffer a clawback. So instead of being able to claim £40,000 of pension tax relief, you're restricted by £1 for every £2 over 150,000. These thresholds have been changed to 200,000 for net income and adjusted income of 240, and the impact is quite dramatic. So in this example of the old rules, if somebody had adjusted income, so that's their net income plus their employer contribution, of 170,000, their pension relief is reduced by £10,000. So they're only entitled to tax relief on pension contribution of 30, but the contribution is actually 55. So they've got a charge on 25,000. Now, £11,250 of tax to find, but you haven't had the cash. So it's not as if you've been given £55,000, out of which you pay your £11,250. So a lot of doctors, once they'd tripped over the 110, they were finding that actually they were paying more in this clawback than they were earning. So there's been a lot of problems and various solutions were suggested, but this one they come up with is quite sensible. So in that example, under the new rules, there'd be no pension charge. These are the new rules. Because the thresholds have been increased, this person's got adjusted income of 270,000, which is pretty decent by any standard, and their pension charge, applying the same principles, would be 13,500. This is only going to catch the really wealthy, so once you've earned more than 312,000, including your pension contribution, the maximum pension relief that you're entitled to is £4,000. So it's taken everybody below the £200,000 limit out of these rules altogether, and it's only the very wealthy who are going to be affected by it. So hopefully the doctors will now go back to work and work some overtime in these rather difficult times. And the other thing I'm going to remind you about, this was actually, these rules were introduced in the 2018 budget, which seems like a long time ago now, but they were to take effect from April 20. There have been no changes to these proposals, and they concern people who own a private residence that they haven't occupied for the whole period of ownership. So you might have moved somewhere else, kept your old home and let it out. In those circumstances in the past, the final 18 months that you owned the property were exempt from capital gains tax. And this was introduced when the property market was very slow, so that sometimes it wasn't always possible to sell your old house before you bought your new one. Well, that's now been reduced to the last 9 months. Although if you have to go into a care home, these rules don't take effect, and your final 36-month period is going to be exempt. And the other reform, and this is probably more significant, is the letting exemption is going to be withdrawn. So if you'd owned a property, you'd lived in it as your home, you'd moved somewhere else, then you let the property out. When you sold the property, you get an additional capital gains tax relief for the let period up to a maximum amount of £40,000. That's been withdrawn altogether as from April, and you will only be able to claim it if you're in shared occupancy. So basically, if you've got a lodger, I suppose. I don't know whether you call them lodgers these days, isn't that politically correct? I don't know. Now, this is best demonstrated by another example. Somebody's owned this house for 12 years. They used to live in it for a year. They've sold it, and they've made a gain of £200,000. Lucky them. Because they owned it, because they'd lived in it for a year, they get 12 months exemption from capital gains tax, plus the last 18 months. So 30 over 144 months of the gain is exempt because it's been your main residence. They've been letting it out as a residential property, so they get the maximum letting relief of £40,000. So their total exemptions when they sell this property before the 5th of April are £81,000, so they've got a taxable gain of 118. If they sell the property after the 5th of April, the picture's very different because the only relief they get is the 12 months that they occupied it, plus the last 9 months, which means the gain goes up to £170,000. And that's quite a significant difference. There won't be many people who are caught by this, but the people who are will notice a substantial difference in the capital gains tax they pay. And the other attack on residential property gains, and we've already had the restriction to the interest relief for let property. As from April 2020, if you sell a second property and it's a residential property, then the gain has to be reported to the Inland Revenue within 30 days and the tax paid. That 30-day period is very, very short. If you're selling your own home, you're not caught. It doesn't affect you. But obviously, our colleagues in the legal profession who are dealing with conveyancing need to be aware of these obligations. And we're in a very strange position now, where if you sold a residential property before the 6th of April 2020, you'd be paying the tax on that gain on the 31st of January 21 under normal self-assessment rules. But if you sold the property a few days after the 6th of April, say, you'd have to pay the tax within 30 days. So there's no transition at all from the old rules to the new rules, which seems very unfair. That's all I want to say to you this morning. I'm going to hand you over to Stephen, who's going to talk to you about the dark side of tax. Thank you very much. Thank you.